Hey there, let's talk about something that's probably touched your life. In one way or another, debt. Yes, that often dreaded word can actually be a stepping stone to financial freedom when you play your cards right. I know it might sound like we're about to sell you a magic bean, but hear us out. This isn't about quick fixes, it's about strategic moves for your wallet. As of the latest reports, Americans are juggling a staggering $14.56 trillion in household debt. Yes, trillion with a T. That's a mountain of mortgages, heaps of student loans, piles of credit card balances, and more. It's easy to see these numbers and feel a bit overwhelmed. But here's the twist. Within those numbers, there are stories of people not just managing their debt, but using it to their advantage. Take, for example, Sarah and Juan, a young couple, passionate about real estate. They didn't let their student loans hold them back. Instead, they refinanced to a lower rate, freeing up cash that they then invested in a rental property. Fast forward to today, and their investment generates enough income to cover their loan payments and then some. Or consider Alex, who used a 0% interest credit card, offered to start a small online business. By keeping expenses low and paying off the balance within the interest-free period, Alex turned what could have been a risky move into a profitable venture. What do these stories have in common? Smart strategies and a shift in perspective. Debt isn't just a burden, it can be an asset if you know how to leverage it. Through this guide, we'll walk you through how to transform your relationship with debt. From refinancing tricks to investment hacks, we've got you covered. Let's dive into how you can make your debt work for you, not against you in your personal finance journey. Understanding debt, a closer look at your financial companion. All right, let's get into the nuts and bolts of debt, shall we? It might not be the most exciting topic at the dinner table, but getting cozy with what debt really means can change your financial game. First off, debt isn't just one big scary monster. It comes in various forms: credit card debt, mortgages, student loans, auto loans, and personal loans, just to name a few. Each has its own set of rules, interest rates, and implications for your financial health. For instance, recent data shows that the average American household carries about $155,622 in debt. That's a hefty sum, but remember, not all debt is created equal. Let's talk interest rates because they're the game changer here. Imagine two friends, Jamie, who's paying off a credit card at a 19% interest rate, and Taylor, who's working on a student loan at 4%. Over time, Jamie could end up paying a small fortune in interest alone, while Taylor keeps more cash in their pocket. That's the power of understanding your debt's terms. But here's where it gets interesting. Debt can also be a tool. Yes, you heard that right. Take mortgages, for instance. With historically low interest rates in recent times, many homeowners have locked in rates that let them own a home for less than the cost of renting in some areas. Plus, they're building equity with every payment. Or consider student loans, a hot topic for many. While the thought of borrowing for education might seem daunting, consider the potential ROI, education, as an investment in future earning potential. The key? Smart borrowing. Opt for federal loans with lower interest rates and protections, and always exhaust scholarships and grants first. And don't forget about credit cards. They're not just debt traps. Used wisely, they can build your credit score, offer rewards, and even finance short-term goals interest-free if you pay off the balance each month. In real life, managing debt is about balance. Imagine managing a portfolio where each debt type is an investment in your financial future. By understanding the terms, rates, and strategic use of different debts, you're not just managing your money, you're mastering it. Strategy 1: mastering debt consolidation and refinancing. Navigating the world of debt consolidation and refinancing can be like finding a shortcut on your daily commute. It can save you time and money, but you've got to know the route. Let's break down these strategies, making them as easy to understand as your favorite GPS app. Debt consolidation is like gathering all your monthly bills, from credit cards to loans, and combining them into one. Why juggle multiple payments with varying interest rates when you can streamline them into a single payment? It's about efficiency and often securing a lower overall interest rate. Imagine you're paying 20% on one credit card, 15% on another, and then a personal loan at 10%. By consolidating, you could potentially lock in a single rate that's lower than the average of those three, say around 12%. Refinancing, on the other hand, is more about renegotiation. You take an existing loan and replace it with a new one, ideally with better terms. This could mean a lower interest rate, a shorter loan term, or both. For example, homeowners have been refinancing mortgages to take advantage of record low rates, some dipping below 3%. This move can significantly reduce the amount of interest paid over the life of the loan and potentially slash monthly payments. Here's a real-life scenario that might hit close to home. Meet Jordan, who had $10,000 in credit card debt across 3 cards, with interest rates soaring up to 24%. By consolidating these into one personal loan at an 11% interest rate, Jordan not only simplified their financial life, but also saved a boatload on interest, cutting their payment period by years. Or consider Taylor, who refinanced their 30-year mortgage from a 4.5% interest rate to a 3% rate on a 15-year term. Yes, the monthly payments went up a bit, but the total interest saved was in the tens of thousands, and they'll own their home outright in half the time. Both strategies come with a caveat. They require a good credit score to get the best terms. But don't let that deter you. Understanding your options, shopping around for rates, and possibly improving your credit score beforehand can make all the difference. Debt doesn't have to be a roadblock on your financial journey. With consolidation and refinancing, it can be a vehicle driving you toward your goals. Strategy 2. Harnessing the power of debt for investment. Imagine turning what most people consider a liability, debt, into one of your biggest assets. It's like using a slingshot. With the right aim and tension, you can hit targets you never thought possible. This strategy is about using borrowed money wisely to invest and potentially yield returns greater than the cost of the debt itself. Let's dive into how this can be a game changer for your financial portfolio. In the current financial climate, with interest rates historically low, the opportunity to borrow money cheaply and invest it in higher returning opportunities has never been more attractive. For instance, if you can secure a loan or line of credit at 4% but invest in a venture that returns 10%, you're looking at a net gain minus any associated risk and tax considerations. Take the story of Mia, for example. Mia took out a personal loan at a 5% interest rate and used it to buy into a franchise that now generates an annual return of 15%. The investment not only covers her loan payments, but also generates extra income. Mia's success story illustrates the potential of leveraging debt, but it also underscores the need for meticulous research and risk assessment. Or consider the real estate market, where many investors use mortgages to purchase rental properties. The rent collected each month can cover the mortgage, and expenses with the surplus as profit. Over time, the property appreciates in value, and the mortgage debt decreases, increasing the investor's equity and wealth. Alex, a savvy real estate investor, utilized a 30-year fixed mortgage to buy a duplex. The rental income covers all his costs and brings in an extra $500 a month. Plus, he's banking on the property's value growing over the years. Investing using debt isn't without its risks. Market fluctuations, interest rate changes, and unexpected financial setbacks can turn a well-planned investment sour. That's why it's crucial to have a clear understanding of the investment, a solid plan to manage the debt, and, ideally, a safety net or emergency fund. Before you dive into leveraging debt for investment, consider your financial stability, risk tolerance, and long-term goals. It's not about taking on more debt for the sake of investment, but about strategic borrowing that aligns with your financial plan. Remember, the aim is to grow your wealth responsibly, turning the tables on debt and making it work for you. Strategy 3. Elevating your credit score through strategic debt management. Did you know that the right kind of debt managed wisely can be a ladder to financial greatness? Yes, you read that correctly. In the realm of personal finance, your credit score is like your GPA, opening or closing doors to future opportunities. Let's explore how you can use debt as a tool to polish your credit report until it shines. The average American credit score hovers around 714, but what if we told you that with some strategic moves, you could surpass this? It's all about showing lenders you're a wizard at managing debt, not avoiding it. Enter Liam, who dreamt of buying a home but was held back by a less than stellar credit score. Liam started with a secured credit card, which required a small deposit acting as his credit limit. By making small purchases and paying them off in full each month, Liam began to build a positive payment history, the number one factor affecting your credit score, contributing to 35% of it. But Liam didn't stop there. He also took out a small installment loan and made timely payments. This added to his credit mix, which accounts for about 10% of your credit score, demonstrating his ability to manage different types of credit. Fast forward a year, and Liam's credit score had jumped significantly. enabling him to qualify for a mortgage with favorable terms. The key? He never let his credit utilization, how much credit he used versus how much he had available, go above 30%. This is crucial because your credit utilization ratio accounts for 30% of your credit score. Liam's story is a testament to the power of using debt strategically. Whether it's a secured credit card, a retail card, or a small personal loan, the goal is the same. Show that you can borrow money and pay it back responsibly. But remember, the strategy comes with a caution label. Only borrow what you can afford to pay back, and always, always pay on time. By following these steps, you're not just borrowing money. You're investing in your financial future. Each payment is a step towards a higher credit score, which translates into lower interest rates and better terms on future loans. It's a journey of turning debt into a tool for building a brighter financial future. Strategy 4. Maximizing financial growth through tax-advantaged debt. In the landscape of personal finance, not all debts are created equal, especially when it comes to taxes. Yes, the right kind of debt can actually work in your favor come tax time, acting almost like a discount on money you're already spending. It's like finding out that a portion of your loan payments can come right back to you. Intrigued? Let's dive into how this strategy can play out in real-life scenarios. Take the case of Emily, a first-time homebuyer. When Emily secured a mortgage to buy her dream home, she also unlocked a potential tax deduction for the interest paid on that mortgage. In the U.S., homeowners can deduct mortgage interest on up to $750,000 of indebtedness, or $375,000 if married filing separately on their primary residence. This isn't just a drop in the bucket. For Emily, this deduction significantly lowered her taxable income, translating to substantial tax savings and making home ownership more affordable. Then there's Jordan, a small business owner. Jordan took out a business loan to expand his cafe, and because those funds were used for business purposes, the interest paid on the loan is considered a business expense. This means it's deductible on his business tax return, effectively reducing the cafe's taxable income and, by extension, Jordan's tax liability. This strategic move not only fueled the growth of his business, but also optimized his financial health through tax advantages. Student loans offer another tax-savvy opportunity. Consider Alex, who recently graduated and began repaying her student loans. She learned she could deduct up to $2,500 of the interest paid on her student loans annually, directly reducing her taxable income. This deduction is especially beneficial for recent grads working to establish their financial footing. What these examples illustrate is the strategic side of certain debts. By understanding and utilizing the tax advantages associated with mortgage interest, business loans, and student loan interest, you can effectively lower your overall tax burden. It's important, however, to stay informed about the specific qualifications for these deductions as tax laws evolve. Embracing these strategies doesn't just mitigate the cost of borrowing, it turns a portion of your debt into an instrument for financial optimization. Always consult with a tax professional to tailor these approaches to your situation, ensuring you're maximizing benefits while staying compliant with current tax laws. This proactive stance on debt can be a key element in your broader financial planning, helping you achieve your financial goals with a bit more ease and a lot more savvy. Risks and considerations. Navigating debt with eyes wide open. While leveraging debt can be like finding a secret passageway to financial success, it's crucial to remember that this path comes with its own set of traps and pitfalls. Let's shine a light on some of the risks and considerations you should keep in mind, keeping our journey through the world of debt both safe and rewarding. Consider Lisa's story. Lisa was enthusiastic about using credit cards for every purchase to earn rewards and boost her credit score. However, she didn't keep a close watch on her spending. Over time, her balances ballooned, and she found herself paying hefty interest payments each month, negating any rewards earned. This scenario underscores the importance of discipline in spending and the peril of letting high-interest debt accumulate. Then there's the case of Mark and Anna, who refinanced their home to tap into equity and invest in the stock market. While the markets were bullish, their investments soared. But when a sudden downturn hit, they found themselves in a precarious position, with investment losses and a home still under a hefty mortgage. Their story is a stark reminder of the volatility in investments and the risk of over-leveraging assets. It's also essential to consider the impact of unforeseen circumstances. The recent global events have shown that job loss or a sudden drop in income can turn manageable debt into an overwhelming burden overnight. An emergency fund, often recommended to be enough to cover 3 to 6 months of expenses, can be a lifeline in such situations, providing a buffer to navigate through tough times without falling into deeper debt. Navigating the world of debt requires a balanced approach, combining ambition with caution. While debt can be a powerful tool for achieving financial goals, it's vital to use it wisely with a clear plan and safety nets in place. By understanding both the potential rewards and risks, you can make informed decisions that align with your financial well-being and long-term objectives. Remember, the goal is not just to manage debt, but to master it, ensuring it serves your journey towards financial freedom, not hinders it. Now, if you want to learn how to achieve financial success, then watch this video next. And if you made it to this point of the video, please like and subscribe to the channel to see more content like this. Thanks for watching, and I'll see you in the next video.